I kind of sort of feel dirty when I'm about to quote something from Deutsche Bank. You know, Walking Dead man, Deutsche Bank. But I mean, they do have analysts and they do make sense sometimes, so they might be making sense on this. And I want to tell you about it. Zero hedge. Deutsche Bank says this is the most dangerous development the Federal Reserve, wants to avoid. What's that? In the first week of February, in the trading session just before the February 5th VIX termination, the market tumbled as a result of a January average hourly earnings number that surged, even though, as we explained at that time, the market had wildly misrepresented the print, prompting speculation that the Fed was dangerously behind the curve and would need to accelerate its tightening, potentially hiking rates more than just 4 times in 2018, leading to an accelerating liquidation of risk assets, which eventually culminated in the record VIX spike. Since then, inflation fears moderated following several downward revisions, quote, as expected, right? And I used to always come out here constantly. Oh, hey guys, revision. Employment numbers, revision. Such and such. Oh, what's that? A double revision. And I used to sing that little song, remember? Ooh, double revision. Look at my eyes. There's a double revision. And it was always to the downside. The revised numbers were always suckier than what we got every time. I haven't forgotten about those days. Not surprisingly, since then, inflation fears moderated following several downward revisions, as expected, and more tame hourly earnings prints. Of course, again, we got to make everything look good. With market concerns instead shifting to trade wars, the return of populism to Europe, the tech bubble, and the sustainability of record margins and net income. But according to a recent analysis by Deutsche Bank's Alexander Kokik, traders are ignoring the risk of an imminent phase shift spike in wages at their own risk. Specifically, he looks at the current, what he calls locus of the Philip curve, which many economists have left for dead due to its seeming failure to explain how the plunge in unemployment to record low levels has, well, failed to boost wages. I'll throw an answer, of a possibility. The numbers are effing fake. And notes that as the economy approaches the full employment level, wages tend to become more responsive. This, to the Deutsche Bank analysts, is the inflection point that the Fed is monitoring. Looking at the Phillips curve over the past 4 economic cycles, he compares it to the Cheshire Cat's smile from Alice in Wonderland, which is present even when the actual cat body is no longer there. In each cycle, it falls apart, but after every annihilation, it recomposes itself and continues to play an important role. Specifically, what he highlights is the sudden phase transitions between the end of one cycle and the start of another, in which one observes a near vertical spike in inflation to the smallest favorable change in underlying conditions. In the Deutsche Bank chart below, each cycle has a different color, which implicitly marks their beginning and end. Hang on. In the current context, the most important message in this graph is the finale of each recovery. In the past, this stage always exhibited a dramatic, practically straight line rise in wages in response to infinitesimal improvements in economic activity. These periods are highlighted with almost vertical lines. Zoom in on that. So we can see 86 to 1990 is the blue, 90 to 2000 is red, 2001 to 2006 is green, and 2007 to 17. The hell are we even looking at there? Where's that vertical line at? Maybe we ain't there yet. That's all right. Because from the looks of it, it might be coming here shortly. Of course, as economists have long lamented, what has prompted many to speculate that the Phillips curve is broken or even dead is the failure of the economy to respond with a sharp increase in wages to the already near record low unemployment rate, which is over 0.5% below what the Fed currently believes is the NAIRU, or non-accelerating inflation rate of unemployment, or the unemployment rate which does not cause inflation to rise or decrease. The NAIRU level corresponding to 1990 is 6% and 5% in 2000 and 2006. Currently, it's around 4.5%. This is the territory where the Fed is likely to become concerned. Allowing the economy to overheat would jeopardize the Fed's ability to control inflation if it rises too fast. So another way of visualizing the potential risk facing both the Fed and traders, is who's in the next chart, which looks at the Phillips curve within the latest economic cycle, starting with the early stagflationary months of 2007, then progressing into several years of recession, before ultimately emerging into the recovery and finally growth and inflation phase. According to this guy, quote, "We are currently in the final stages of the recovery. If we enter the Goldilocks region, upper left-hand corner, too fast," which I'm not going to put up the chart, "the Fed could be caught behind the curve and might be forced to hike aggressively, which could have a negative impact on growth while leaving only inflation behind. A recipe for progressing straight into another recession." And as Deutsche Bank warns, and as the events of early February so vividly demonstrated, this is the most dangerous development which the Fed would want to avoid, underscoring why it is only a matter of time before the Phillips curve, which he believes is not dead, but merely waiting to erupt in a near vertical spike, reveals some fireworks. He notes that in addition to the distance from the NAIRU and the inflation target, the actual non-linearity of the curve is the key development to watch. In particular, the change in the response of inflation to the decline in unemployment. And he says the economy is currently operating below NAIRU and just slightly below the target, and has shown a sustained support for higher slope, which has been persistent since the end of 2016. This has caught the market's attention. But it's not just the Phillips curve that's caught the attention of Mr. Kosick. As regular readers will recall, back in the summer of 2013, we first speculated that Okun's law is either broken or there is a giant and inexplicable output gap forming in the U.S. economy in which GDP was trending far below where the unemployment rate suggested it should be. Now, 5 years later, that output gap is finally closing. And according to him, if past is prologue, it may do so in an explosive manner. And this is how he frames it. The figure below shows the Okun's law, which captures the interplay between the social and economic response to the crisis in terms of distance of unemployment rate from NAIRU, social, and output gap, economic. Historically, output gap closes roughly when unemployment rate or unemployment reaches the NAIRU. We'll just call it the NAIRU. The long-term intercept beta is close to zero. Post-2007, there has been a structural break in this relationship. The economy was slower to recover. It required more aggressive improvement of labor market in order for the growth to reach its potential. This is shown in the figure through lower intercept. Unemployment has to decline about 0.8% below NAIRU for the gap to close. So according to him, if the unemployment rate is already low enough to potentially trigger a near vertical spike in wages, Phillips curve, it is also low enough to launch a sharp reversal in the output gap, or the Okun rule, leading to a Fed that is behind the curve on the parameters, or as the DB Deutsche Bank analyst says, with current unemployment rate already 0.5% at narrow, it is only 0.25% away from closing the output gap. This justifies possible Fed concerns. Then again, if Kosick's historical analog for the current situation is correct, nightmares may be a better word than concerns. The reason for that is that the appropriate historical period to compare the current regime is to the 1960s, when the output gap exploded. While we think that history might not be the best guide for the future at the moment, the lessons of the 1960s are difficult to be completely ignored. The figure below shows the unfolded Okun's law. 1960s are a screaming example of the effect of exploding output gap as a consequence of injection of fiscal stimulus when the economy was already operating at full employment, a situation that bears keen similarity to the present. I'm not going to show that. There's no need to see it. If the Deutsche Bank analysis is accurate, the implications would be profound for the market, which would find itself not only observing a sudden spike higher in wages, but also an economy where the actual GDP is suddenly soaring far above the potential, resulting in a 1960s output gap rerun and a Fed that has never been so far behind the curve. The outcome of both would be even more aggressive rate hikes by the Fed, which, if the scenario plays out as Kosick envisioned, would be forced to raise rates well more than the 7 or so hikes the latest dots currently envisioned for 2018 and 2019, resulting in another bout of exploding volatility as the market finds itself not only chasing the dots, but in a rerun of February where to catch up to inflation. First the Fed and then the market would be forced to aggressively tighten fiscal or financial conditions. So if the Fed ends up having to aggressively raise rates, I'll say something I've said 1,000 times. What's going to happen to the price of housing? Your mortgage rate will go up. It will go up. If the mortgage rates go up, so do credit card rates. So do anything interest related will go up. But more importantly, mortgages, because that's the most expensive thing you'll pay for. And if that's the case, housing has to come down significantly to meet the equilibrium of your payment. Higher interest rates, higher payment, but more money's going to the bank. Same house, same everything, but the interest rate changed, you now owe more money. Now, the other side of this, adjustable rate mortgages, ARMs, remember those? That's what caused the financial crisis. It was the adjustable rate mortgages. No, it wasn't. Certainly didn't help, but that wasn't the cause of it at all. That was one of those things that when that whole thing implodes, that just makes it more devastating. Because interest rates rising, your adjustable rate mortgage changing. Oh, you owe a lot more now. My mortgage just went up $300 a month. Yep. I can't afford that. What am I going to do? You're going to walk. And walk they did. So point of me telling you that right now, that was 2008. Adjustable rate mortgages still exist. And there are a lot of people who got into some of them. Not some of them, a lot of people who got into adjustable rate mortgages and have them right now. So as the Fed may have to keep ticking up and maybe tick up that interest rate higher and higher quicker, more frequently, what happens when those adjustable rate mortgages come due? Up. Yours was a 5-year, yours was a 3-year, whatever it was. What's the new rate? What? How much is it going up? 2008 all over again. I'll say it again. If we can get lucky, cryptocurrencies, rocketing. Housing market, not that I want to see it, but hey, it happens. Housing market, down. You and me, let's go find some property to invest in and fix your upper house, whatever. Maybe we'll have to put up some of those more RV places, concrete pad, little dump station on site, sewer hookup, water, electric. Done. Asset. Market crash, up, down, doesn't matter. Got a hard asset. That's the name of the game. Get some hard assets. But if we can time this right, crypto's up, housing down, everything else may be down. Because, I mean, in all fairness, this whole damn thing needs to reset. I was talking to my dad today, Father's Day. We're all over at my house today. We're talking about early 1900s. Mortgage would be 5 years to 10 years or something like that. And you'd have to come up with 50% of the money down for the house. And then you'd mortgage the rest. But again, it was for 5 or 10 years. That was it. And then we had the Great Depression. The president said, rather than kick everybody out of their houses because we can't afford it, it's too much money, we're going to create this new thing. We're going to extend it for 30 years. Whatever your mortgage is now, we're going to extend it for 30 years, which will drop the payments massively. So you can afford to keep your house and stay in there. Yeah, all right, yay. And thus the 30-year mortgage was born. But now we've got extremely high prices. And you got 30 years to pay it off. Which means, if we were to go back to the way things were, theoretically, houses should be priced to where the average person should be able to get a mortgage They should already have half the money in their pocket to put down on that house, and then the other half, get your mortgage for 10 years. And that was it. Do you know, and I'm sure the answer is no, anybody that has half of the money to put down on a house these days? The average American, 90% of Americans, 80%, whatever it is, huge number, you know it is. Ain't got half the money, there's a $250,000 house. Oh, I've got, half of that, 175,000, or actually that'd be more like 125,000, whatever. In my back pocket, yeah, let me put that down, Not only that, imagine putting that down and then somehow in the next 10 years you lose your job and you're getting foreclosed on and you think, I just dumped $125,000 down payment on that house. I owe 6 more years left on the mortgage. I lost my job and I can't pay it. I'm going to lose the house now. Right. But at the same time, if you had $125,000 in your pocket, you wouldn't have been living paycheck to paycheck. Like back in the day, people actually had some money. Anyways, take care.